Hello, welcome all. And look, I'll do my level best to make the scintillating subject of regulation even more scintillating. I know that for many of you, it's probably dry at best and the bane of your lives. And I can understand that, even though it's actually quite a radically changing area. Many of you probably roll your eyes and think, oh yes, more regulation coming our way, and certainly in the last few years that's been the case, and I don't think that's over yet. You might console yourselves that the developments in New Zealand in terms of increasing regulation, prudential regulation, market conduct regulation, AML regulation, is not being done in a vacuum. Internationally, a lot's going on. And so today what I thought I would do is run through briefly what's happened on the local market with insurance regulation, then put that into international context as to, well, what's on the radar screen coming up internationally that could well influence the future direction of regulation for the insurance sector in this country. But then I want to get in towards the end of the seminar on the need for balance, because there is a real risk that regulators, armed with new laws, new regulations, they've got the bit between their teeth, and you know, they've had a good cup of black coffee and whatever else to get them going in the morning, that they're really fired up, and there is a risk of overshoot. And that is something I think we all need to be wary of, and I think the Productivity Commission's review of regulation is going to be pretty crucial in that regard, and trying to get more of a balance that will hopefully avoid some of the excessive regulatory responses. So I want to talk about that as well, but maybe just kick off with what's been going on in the last 2 or 3 years in terms of regulation affecting the insurance industry. And look, you'll be familiar with this, so I'll skip through it pretty quickly. I guess one of the biggest developments was the introduction of the Insurance Prudential Supervision Act 2010. And look, I imagine most of you don't go through the bowels of that. It would be a pretty sad day if you were to. The fact that I do suggests that I haven't got a life, but no, it's only part of what I do. I also look at tax laws and banking laws, etc. The Insurance Prudential Supervision Act really was quite a new landmark in insurance regulation, because what it did was, for the first time, brought in a formalised prudential supervision framework for the insurance sector. And that was a big shift from where we were, which was essentially industry self-regulation, which was working pretty well, I must say, with a little bit of regulation from the former MED and government actuary overseeing it. But that was pretty much a light touch approach. Whereas what the Prudential Supervision Framework now does is it brings New Zealand really into line to a fair degree with the international mainstream. In a sense, we've been probably 10, 15 years behind the curve. And so now you might say, well, 10 or 15 years, the Reserve Bank is probably going to try to make up for that time gap in the space of 1, 2 or 3 years. And that is something that one needs to be careful about doing, because you want to move gradually, you want to take industry with you, and you want to make sure you don't bite off more than you can chew. You want to get the balance right. The Act lifts the game quite a lot. I mean, it provides for licensing, and of course the licensing process has recently been completed. Solvency requirements, financial strength ratings, that's actually quite unusual by international standards. In most respects, the insurance regulation regime now established is pretty orthodox by the international benchmarks. One or two areas are not, though. One is financial strength ratings, which I personally see merit in, but I mean, it's intended to strengthen market discipline. It's intended to reduce moral hazard risk. It's intended to reduce the need for a heavier degree of prudential regulation and therefore lower compliance burdens, and one hopes that it works out that way. But by international standards, it is not usual for insurers, or for that matter banks, to be subject to a ratings requirement. Fit and proper requirements, that's pretty standard globally. Risk management frameworks likewise, and I'll talk about those a little more and where that's headed internationally, and the need to have an appointed actuary. The Act gives wide-ranging powers to the Reserve Bank, and look, most of these are pretty standard as well. You might think some of them go further than you would like, but in fact they are pretty much in line with where the international standard setters say an insurer should have powers, an insurer regulator should have powers. So the ability, as I mentioned, to license insurers and attach conditions to licenses, to set prudential standards, to monitor them, to take enforcement action when there's a non-compliance issue, and then escalating through to the management of a distressed situation, the ability, for example, to put an insurer into run-off mode, or in more extreme circumstances to seek the approval of the government for the appointment of a statutory manager. And so that's into the full crisis management mode. And again, all of that pretty orthodox stuff, the crucial bit is making sure that the checks and balances are right there, and I'll come on to that a little bit later. And so by international standards, as I say, what we're looking at, although it's a radical shift for us, isn't that radical in the global context. There are one or two things, though, that do stand out as being a little different. The objectives of insurance regulation are basically to promote a sound and efficient insurance sector. Well, that's fairly internationally standard, and public confidence in the sector. Interestingly, one thing that is different is that if you look at Australia, Britain, Europe, the United States, most of Asia, the explicit protection of policyholder interests is also an objective of regulation. And that is not an objective of regulation under the Insurance Prudential Supervision Act. And I'll come on to the significance of that later, because that might suggest that it could be a more light-hearted, light-handed regime than it might be if there were a more explicit policyholder protection function. But it also raises questions about where might it go when the rest of the world is increasingly moving towards explicit policyholder compensation schemes, and where we are seen increasingly as an outlier in that way. The parallel, by the way, is on banking, where, again, in banking supervision, there's no explicit depositor protection objective, and unusually, we're the only country in the developed world without deposit insurance. And again, there's a question mark as to, well, what might the future bring there, as to whether New Zealand effectively gets forced internationally to move towards a more formalised deposit insurance, policyholder compensation insurance framework, and what would that do to the insurance regulation framework. None of this is happening in a vacuum. The work that's been done in the last 2 or 3 years locally on strengthening insurance regulation has been in the context of a heck of a lot of activity globally. And look, probably many of you are familiar with that. So I don't want to go into the depths of it too much. I want to just touch on a few themes. There are 2 international bodies that are worth keeping a weather eye on, because they will influence developments here. One is the IAIS. Now, that you mightn't have heard of that, but it's It's the insurance, the International Association of Insurance Supervisors, IAIS, and it is the international standard setting body for insurance supervision around the world. And the other one is the Financial Stability Board, and you might have heard of that. It's basically a creature of the G20. New Zealand is not a member of the Financial Stability Board, but it is significantly influenced in its broader regulatory framework and its central banking arrangements by developments in the Financial Stability Board. And both the IAIS and the FSB are doing quite a lot in the area of strengthening insurance regulation. So what have the IAIS been up to? Well, first of all, they have what's called the Insurance Core Principles, and that's kind of the Bible of insurance supervisors. It sets out the basic principles that insurance supervisors around the world are expected to follow in relation to things like supervisory objectives, powers, accountability, licensing, fit and proper requirements, corporate governance requirements, risk management, supervision, the enforcement, and how you manage a financial crisis. Now, all of that is pretty standard stuff. The significance of it is that every now and then the IMF come in to do an evaluation of New Zealand, as they do every country. The last one that was done was 2003. The next one, I don't know when it will be. Australia had one last year, and I was involved in that. And I'm one of those rare beasts who've been FSAP'd, and I've been an FSAPper. FSAP is the Financial Sector Assessment Program. It's when the IMF come in, crawl all over you for 2 or 3 weeks, review all of your regulatory frameworks, do a stress test on the financial system, write up vast quantities of reports, several metric tons, and then out of that drops some key recommendations. The last one done here, as I say, was 2003, and out of that came a rather belated recommendation for a licensing supervision framework for insurance and for non-bank deposit takers. It influenced quite a lot the future architecture of the New Zealand financial system. Now, when they next come, which might be in a couple of years, I don't know, sure as eggs they're going to be looking at the insurance sector, as well as the banking sector and the non-bank deposit sector and the payment system. And they're going to be assessing the regulatory framework against those international benchmarks. Now, I think we will probably end up scoring reasonably well, but time will tell. There will be certain areas that they will no doubt want to drill into, and I'll come on to those shortly. Another theme that the IAIS has been big on recently is what's called as the Common Framework for the Supervision of Internationally Active Insurance Groups. Now, that has limited direct relevance to New Zealand. Essentially what it's about is for the big international insurers, they are moving increasingly towards wanting to have a broadly standardized, international agreed supervision framework, so that wherever a large multinational insurer operates, whether it's through its head office, whether it's through a branch structure or a subsidiary, it'll be supervised more or less in a common way across the different home and host jurisdictions. Now, the relevance of that for us is not so much for the big international insurers, but the potential for that to translate to what might that give rise to for the domestically large insurers. It's a bit like the parallel with what's happened in the banking world, where you've got your what's called the G-SIFIs. I don't know how many of you have heard of it. It sounds almost like a disease, doesn't it, really? G-SIFI. If you said that you had a G-SIFI, you'd probably move a little bit further away from them. But in fact, what it means is globally, systemically important financial institution. Some of them are banks, some of them are insurers, some of them are conglomerates. And what's happening there is there's an increasing move to say, well, okay, for the identified global SIFIs, as I say, some of them are insurers, they are lifting the game in terms of higher solvency requirements, more intensive supervision, tighter control over risk management, tighter control over governance and board structures, more frequent supervisory review. That is also going to translate into a domestic SIFI context as well. That's the next wave. So the global SIFI is where it's globally, around the world, systemically important. Now, there are no insurers domiciled here that are globally systemically important. But there are some insurers here that are systemically important in the New Zealand financial system. They might be systemically important in terms of their dominance in certain niche markets, their impact on the real economy, their linkages into financial conglomerates, their capacity to disrupt financial markets upon their failure, the impact on confidence, the impact on foreign investment flows, a whole swag of reasons why the larger insurers here may be domestically, systemically important. So the thing to watch, I think, on the radar screen, looking a little bit further out, is the extent to which we are going to see international pressure for, if you like, a tougher set of supervisory measures for the larger insurers that come out of this global SIFI and de-SIFI environment. Another theme that's coming out of the IAIS that I think is worth noting is consumer protection and guarantee schemes. They released a paper. You might want to wait for the film. The script is a long and difficult read, but the film mightn't be that exciting either. Essentially what it's about is saying that for most countries around the world, we have a deposit insurance scheme. So when a bank fails, what happens is that the bank is closed down and depositors are paid out through an explicit deposit insurance fund that's funded by the industry. Now, Australia brought that in just 5 years ago. In fact, I led the work in Australia doing that. I also led the work developing a parallel for the insurance side so that if an insurer fails, there's a policyholder compensation scheme, and that kicks in. So you put the insurer into liquidation, and then the policyholder compensation scheme pays out, and then it takes first bite of the cherry of the assets in liquidation of that insurer. Now, New Zealand hasn't got either of those structures here, and maybe will never have, although I doubt it. I suspect that we will be moving to a world where that quite potentially could happen. So we'll see, but that's something to keep an eye on because that will have implications for the structure of the industry, the regulatory impost that might come on it, and what kind of levies might be used to fund such a compensation arrangement. And there are some pretty big issues on that one. Financial stability is another angle that I think is worth touching on. The IAIS has done quite a bit of work on looking into how systemically important are insurers. You know, traditionally, we've known that banks, big banks especially, if they fail, can cause systemic mayhem through a number of channels: contagion risks, impact on financial markets, impact on the real economy, contraction of credit, and so forth. It's generally been thought that insurers, while they're clearly fundamentally important to the real economy, are systemically less critical. And I mean less critical because of the lower contagion risk, less critical because of related party exposures, less critical because of dislocation or the lack of it to financial markets, financial systems, payment systems, settlement systems. More recently, though, there's been deeper thought on that subject, both by the IAIS and the Financial Stability Board. And so what's coming out of that, again, is the idea of regulators developing a more more of a framework for identifying what are the potential systemic flow-on effects that large insurers could have, both locally and globally, and what might be done about that in terms of potentially higher capital requirements. In some cases, liquidity buffers are less relevant for the insurance sector, but not totally. What kind of crisis resolution measures should be put in place? And I'll come on to crisis resolution soon, because that raises questions about recovery planning requirements and resolution planning requirements. And you might have heard a bit about that, the living will notion in the banking sector. Well, I think it's going to come to the insurance sector as well at a certain point. The Financial Stability Board has been also active in the insurance space, and they've touched on 2 or 3 themes. One of them is on risk appetite, risk management, and governance. And look, it's not telling you anything you guys don't already know about running an insurer. Governance is obviously hugely important in terms of a robust board, well-qualified board, a risk management committee, an audit committee, a remuneration committee, or at least board structures that deal with those issues thoroughly. Risk appetite may be something that is less visible in some parts of the insurance sector than in the banking sector. Risk management frameworks clearly fundamental, but what the FSB is now starting to bang the drum quite loudly on is the need for much greater focus on the role of the board in overseeing risk appetite, calibrating the risk appetite. So what is your tolerance for risk? If you want to be, say, a AA rated insurer, you want to hover between this level and this level of solvency. You want to be able to cope with X deviations along the curve in terms of magnitude and duration of shock. So that's what your risk appetite is. How does that translate into what kind of underwriting standards you will have, what kind of risk exposures you will have, what kind of concentration of risk to reinsurers you're willing to have, and so forth. And so the FSB has been doing a lot of work in that space. They brought a report out in February this year. It is a lengthy report. You might just read the executive summary, and that's only 417 pages. So that's actually a quick read. If you've got insomnia, it's cured. Actually, it keeps me awake at night reading these things. That's how sad it is for me. But the reason I mention this is that I think you'll find that supervisors, including potentially the RBNZ, are going to be increasingly influenced by where the rest of the world is going in terms of more emphasis on risk appetite, integrating risk appetite into risk management, risk appetite statements that are much more forward-looking, with leading indicators of incipient risks being factored into the calibration of risk tolerance levels, and how the governance framework sits across all of that. Another theme that's come out of the FSB has been in the macro-financial side. And again, we tend to think of this as mainly in the banking sphere, but it's becoming increasingly evident that it's relevant to insurance as well. And here I'm talking about stress testing and macro-financial stability assessment. Both at a macro level, that is across the industry as a whole. If you belted the insurance sector with a series of macro shocks, how resilient would it be out of that process? So if, for example, you hit the insurance sector with a series of claim shocks, coupled with asset price shocks, coupled with real economy shocks that might impede, for example, the ability of policyholders to continue to service their debt, or you did a stress test on hitting the reinsurance market with a severe set of shocks, both in terms of duration, direction, and magnitude, what would the insurance sector look like out of doing that kind of stress testing? That's done in banking increasingly, and I mentioned the FSAP before, the Financial Sector Assessment Program, where the IMF comes in. Well, one of the things that they do is they go in and they look at the banking sector, they do a series of stress tests, and they evaluate how vulnerable is the New Zealand banking system to a series of shocks like that. And that informs questions about how high should capital ratios be, how tight should related party exposure limits be, how much tighter should lending policies be, etc. In the insurance sector, it will not in the least surprise me if we see the next time the IMF coming in wanting to do a stress test of the insurance sector. And increasingly, Australia, for example, Britain, the United States are moving in that direction. But not just at a macro level, they're also wanting to use stress testing as a technique, or rather inviting the boards and the senior management teams of insurers to demonstrate how do you use stress testing to calibrate your risk appetite. What kind of stress tests do you run in order to inform your ICAP, your capital planning, in order to inform your pricing of insurance products, in order to inform your positions on concentration of reinsurance risk. And so, the three areas of stress testing most likely to be looked at are scenario-based stress testing, where you take a scenario and you run your balance sheet through that. So it could be a macro shock, it could be a claim shock. Another one is single factor stress testing, where you might run your balance sheet through a yield curve shock or through a certain set of asset price shocks. And then a third form of stress test is reverse stress testing, which is how do you kill the insurer, basically? What is the magnitude and duration of shock that will tip you over? And one would hope to never get there, of course, but it can be an informative exercise to then say, well, okay, what does that tell us about how we've calibrated risk appetite in our risk management frameworks? And how does it inform us about ICAP? Briefly, and picking up the pace, mindful of time, the FSB has also been banging the drum quite loudly on crisis resolution. Now, you'd be forgiven for not having read the key attributes of effective resolution regimes for financial institutions. That's another compelling read. I would urge you to read it. I wrote some of it. It is a beautiful read. It's poetry, really. It's essentially the new international standard on crisis resolution for banks, insurers, payment systems, settlement systems, securities and investment firms. It's again something that the IMF are going to come in, they're going to evaluate this country, as they do most countries, on how do your resolution frameworks stack up against these international standards. We've seen in the banking area the Reserve Bank move towards addressing elements of this with their open bank resolution framework. And some of that has merit, some of it has question marks, and we can leave that to one side today. But areas that haven't yet been touched, here at least, are recovery and resolution planning. And I don't know how much you are aware of living wills, but they basically divide into a game of two halves. One is recovery planning, and that is, what are the things that you can do if you're belted with a shock that knocks your capital by 30%, whether it's through a claim shock of unexpected magnitude, or an asset price shock, or a parental shock. What is the recovery strategy that you've got to get yourselves back to a level footing without having to go into either formalised resolution, i.e. closure and some kind of payout process, or merger into another insurer, or into run-off mode? If you want to preserve franchise value and basically be there in another 30, 40 years' time, what's the recovery strategy you need for that? So it's capital raising, it's the nature of the dispositions of non-critical portfolios that you might want to bring to play. Well, that's essentially what recovery planning is about. Banks are now being required in Australia to do just that. For my sins, I was on the pilot program that introduced that for Australia. And Australia is going to be introducing recovery planning requirements for insurers either next year or the following year. Now, some of that might flow down to the subsidiaries or branches of Australian insurers. Resolution planning is really almost like planning your own funeral, so much less appetite for doing that, really. It's when the shock is so deep that you can't recover, and so you get, people coming in from the Reserve Bank dressed probably in black clothing at this point, and it's really about not necessarily burial, but about how you resolve it in such a way that minimises systemic flow-on effects. And it might involve business transfer of portfolios, it might involve payout arrangements in some cases, or a restructuring through a bridge entity. Resolution planning is something that the Brits and the Americans and the Europeans are now big on for banks and for insurers. And the significance of that is it can require pre-positioning of portfolio structures and corporate structures so that there is a simplification of groups such that it is easier to pluck out the systemically important stuff and then almost like a module slide it into a bridge entity or into another entity. And then the rest of the stuff deemed to be systemically unimportant closed down. I won't dwell on it, but that's something to watch for the future. Briefly, closer to home, Australia, as you would know, has been active in insurance regulation for a long time now, and indeed in many respects are viewed as one of the world leaders in this space. Their capital framework, LAGIC, has started to work its magic across the Tasman, and that brings in a much more Basel-like capital framework than it ever was before. The feedback from the market that I've heard has been generally positive, but they're wanting now a period of consolidation. It's been a hell of a lot of work to bed it down. One of the interesting elements of that is the need for ICAP. Essentially, ICAP is the internal capital adequacy assessment process, and that's something that APRA is putting a lot of stress on and requiring boards to take ownership and responsibility for. Essentially, it's about how do you assess what your capital position should be against all these stress-tested shocks, and what's the strategy for maintaining capital in an environment where your capital is likely to be buffeted more by a more volatile market condition than might otherwise have been the case. APRA is also bringing in major risk management changes. From 1 January 2015, they're bringing in a new prudential standard that will apply uniformly across banks and insurers, as well as superannuation. And that's going to lift the game quite a lot. It might have some ramifications for New Zealand operations of Australian insurers. What it does is it formalises the need for a risk appetite statement, for that to be integrated into the broader risk management framework. It charges the board with annually attesting to the robustness of the risk appetite statement and the risk management system. It requires a dedicated chief risk officer who reports to the board. It requires formalised stress testing and scenario analysis to calibrate the risk management framework. And it also requires 3 yearly external reviews of the risk management framework. So that's quite a quantum change in regulation. Related to that is the APRA move on conglomerates, where, and this is unusual, this is where APRA are well ahead of the curve internationally. From 1 January 2015, they're bringing in a new framework that says, look, if you've got a bank, an insurer, a wealth management function, a superannuation management function, and it's all wrapped up into one group, as many are now, you're going to have a level 3, it's called a level 3 group, a conglomerate. You're going to have a level 3 entity that sits above all of that. You're going to have a capital framework that embraces the risks of the entirety of that group. You're going to have to track intra-group contagion risk and identify what those intra-group contagion channels are and have mitigants against those risks. And you're going to have to measure large exposures against the entirety of that group. That is going to be far-reaching. It's going to bring about major changes to the governance arrangements of some of the very large Australian players, with flow-on effects potentially down here. Recovery planning, I'll skip over that. I've mentioned it, but APRA is clearly marching forward on requiring recovery planning in the insurance sector. So that'll be coming along some point late 2014, perhaps early 2015. Well, what does all of this mean for New Zealand? Clearly, we're influenced by international developments, Australia especially, but also the broader global developments. But we're not under any treaty or legal obligations to follow international standards, and that's a good thing, because some of them don't translate well to a very small economy that is primarily a host supervision framework for international banks, and in the case of the insurance sector, a very mixed bag of different kinds of insurers: mutuals, companies, large, small, specialist, foreign-owned, locally owned. You don't want to have a one-size-fits-all approach, and the Reserve Bank actually has a pretty good track record of not slavishly following international standards. But it is going to be influenced by these international developments quite significantly. And so what we need, I think, is to ensure a sensible balance. And mindful of time, I'm just going to move fairly quickly through the key points now and then conclude. The importance of getting the balance right is crucial, because we have seen many examples of misguided regulation where the compliance burdens, the unintended consequences, the efficiency distortions have really been damaging to the economy. We've seen that, there are examples of that in some of the stuff that the ICNZ has done over the years, although they've by and large, I think, made a good effort to try to minimise that. But it's inevitable. In any regulatory field, there's a tension between wanting to promote a sound financial system on the one hand and wanting to counterbalance that with maintaining efficiency, maintaining market discipline, making sure that those who best placed to manage risks are left to do so in the boardroom and not on the supervisor's table. And so the Insurance Prudential Supervision Act actually does provide a pretty good framework for trying to get that balance right. As you may know, it sets out a whole lot of principles that ask the Reserve Bank to observe those principles in the development of prudential supervision. It's essentially about maintaining the sustainability of the insurance market, maintaining the competitiveness of the insurance market. It's about protecting the interests of policyholders and the public interest, minimising systemic damage, but not taking it to the point where you are effectively insulating policyholders from all risk. So it's trying to get a balance there. It's about trying to maintain a competitively neutral framework as best one can, so consistency of treatment across similar institutions, but equally to recognise that the insurance sector is a diverse sector. As I mentioned, companies, mutuals, many different beasts out there, and so you want to have a balance that takes that into account. And so I think the messages for the regulators, including the Reserve Bank, is they need to explain in a comprehensive and transparent manner, maybe more than they've been doing to date, how they interpret the Act's objectives, particularly how they balance soundness and efficiency, how they take into account those principles set out in the Act. I think there's a need for a more robust and thorough consultation process. I hear many stories of insurers being frustrated at the lack of adequate consultation, and I think there's always scope to lift the game there. I think there's merit in contemplating having a standing industry working group, for example, that would meet with the Reserve Bank on an ongoing basis to help the Reserve Bank and the industry work together to get a better quality of outcome. It's crucial, I think, that there be a balance between regulatory discipline, self-discipline and market discipline, and that the Reserve Bank don't push regulation to the point where it weakens self-discipline and market discipline and creates excessive regulatory burdens. There's a need for the Reserve Bank to work more closely, I think, with the FMA so that there's tighter coordination, less duplication of effort, but also to work closely with the Australians. That cross-border coordination is so crucial if we're to have a lean and mean insurance supervisory framework here that works well with international principles. In concluding, I just draw your attention briefly to the Productivity Commission's work, because I think this is really relevant. They have commenced a review, as you may know, of regulation in this country, and I think it's well overdue. And the points that I would really emphasise, you raising with them and raising with government, is the need for regulatory proposals to be subject to a much more rigorous cost-benefit analysis than is done typically, with much greater independent expertise involved in that process. Too often regulatory impact statements are drafted by the regulator, obviously and reasonably. They're wanting to push their own barrow. They try to be balanced, but no one can be balanced totally. You're always going to talk your own book. And so cost-benefit analysis suffers in that regard. They are not as rigorous as they should be. There's a crucial importance in separating the responsibility of legislative policy development from the administration of regulation. Generally, that is observed in this country, but in the case of the Reserve Bank and one or two others, it isn't, where they effectively hold the pen, and I think that has to change. I think there needs to be a thorough review of the allocation of regulatory powers, such that some are vested in Cabinet through regulation and get scrutiny through that process. Some are vested in a minister and they get scrutiny through that. Some are vested in the regulator itself, and a lot of the powers in prudential supervision are vested in the Reserve Bank itself. And they're not alone. And so there's a need, I think, to revisit the allocation of those powers and the accountabilities there. I think we also need to strengthen the performance assessment of regulators, strengthen their accountability, their transparency, have periodic independent reviews, expert reviews of how they're doing their job, and is the regulatory framework stacking up against the objectives set for it. And finally, an issue that I've raised with the Commission, and I know a number have, is the need to consider whether we should have a merits review framework established in this country. In Australia, they've had merits review for a long time, 35, 40 years. Essentially, merits review is where a regulated entity can go to an independent court to say, look guys, despite the consultation process, the regulator, whoever it is, has ignored the points we've made or hasn't adequately taken them aboard. We find that what's come out of it is not satisfactory. We are seeking independent review. In Australia, that does happen, and the judicial body can overturn that regulation or send it back to the regulator and say, start again. We don't have that here. Australia does have it, and I think that's a big gap that should be filled. But look, I've gone over time. I apologise for that, but thank you very much for your indulgence.
I think coffee's overrated at times, so I think we've got time for perhaps one or two quick questions. Rebecca, we just grab that mic.
Thank you. Geoff, I have a comment and a question. You highlighted that there may be more supervisory interest in our large insurers, domestically, those who are domestically systemically important. And I just wanted to comment that I think within IPSA already, there is that ability through the licensing, supervision and distress management part of the IPSA regime for the Reserve Bank to pay more attention in that area already. So I'm not sure that I envisage that going forward. There will be, closer scrutiny in that area. My question is, those insurers who are not on the list of 9 globally, who are seen as being systemically important, surely there are opportunities for those insurers and across in banks as well who are not on that list. Our part of the world obviously hasn't been viewed as being so globally systemically important. What opportunities do you see for insurers in our area who are not on that list and won't have the increased cost of capital?
Well, it's hard to know really how it'll work out. I mean, I suspect you'll see a gradual increasing in capital requirements for the globally systemically important players, a strengthening of the recovery planning requirements and resolution pre-positioning. That might potentially filter through to those that are deemed to be domestically systemically important as well. What it might do is open up opportunities at the smaller end of the market to more economically provide niche products in markets because they are under somewhat less regulatory burden, if I can put it that way, than the larger players. So it might potentially create some opportunities in niche markets. I wouldn't push that too far, but I think there's potentially an opportunity there.
Well, I think coffee's not overrated that much, but we don't want to take up far too much time. But I did say to you, here is a man who's passionate about regulation, and regulation is just so important for the future direction of the industry. And over the next few years, we're going to see regulatory impact digging deeper and deeper into the industry. So, this is just so important.